Hey guys, sorry for that. Welcome back. Please let me know if you can hear me. Can you, Haron? Yeah, just let me know if you can hear me. All right, you can hear us. Perfect. So let's just give it a second, guys. Let's wait a couple of seconds to make sure the sound comes out right, and then we're gonna start. All right, welcome everyone. And in the session today, we're going to go over our latest product development, some of our product training, and we're also going to go over our use cases, training example, and then at the end, we're going to answer some questions. So please stay tuned and please post it in the comments and let us know, guys, if you can hear us as well. Got it? All right, so before we go into that, one of the questions that people always ask is like, you're coming from the institutional world, and how do institutions really trade, and how do they relate to retail trading, and how do they compare, right? So when people imagine how institutional trades, they often think that they just have more screen, they have faster software, or better chart setups. But in reality, institutional trading is not about charts, it's about data, risk management, and position management, right? So institutional desks really care about how much risk they're carrying, when market participants are positioned, how volatility will affect the price behavior, and what macro regime are we on? Are we in a risk on or risk off scenario? And therefore, they will use data to potentially position themselves. So it's more about probabilities using models than actually looking at charts, right? So if we, on the other hand, go and look at how retail traders behave, they look at a lot of technical indicators, they look at history, but in reality, institutions do not actually look at charts. So it's very, very important that we understand that institutions do not trade with charts. And the reason is very, very simple. Institutions are looking at the future or the risk in the future, right? So when price reaches a level, institutional trader, they would ask the following questions, right? So who is short at this level? Where are the dealers hedged? Where are the market makers positions? And what is the implied volatility of the asset? And none of these questions can be answered by candlestick charts, can be answered by technical charts. And that's why funds use data models and market microstructure, not just patterns in the chart, right? So for example, here we see a head and shoulder pattern, but that doesn't mean anything for an institutions, because what if the option market is positioned in the other way? So institutions really care about positioning, about liquidity, about market structure, right? So that's why we get the question is like, what is the gap between retail investors and institutional traders, right? And what we can see in this slide is really that retail traders are often playing a different game completely. So while institutions are allocating risk in probabilistic frameworks, retail are most likely guessing with lagging indicators, right? So if we look at the indicators that we use, sometimes those are lagging. So they're not actually able to predict the future, they're just looking at the past. So the problem isn't really the know-how, the technology, is really the access and the process, right? So retail traders, they have no visibility on market makers positioning. They don't have a systematic risk system, so they don't really look at risk management as much as institutions do. And they often trade with emotions, right? Following trends that they hear on social media. They're actually not looking at the data, right? And that's why basically the risk for retail traders is that we normally get trapped in fake breakouts, and we're most likely trading in the dark. So retail traders also rely on social media. They like to look at famous YouTuber. They like to copy strategies. But again, some of these signals that are used by the old markets, they sometimes do not consist of an edge. Right? So if you are following an indicator that everybody's using, like the example we had before was the RSI, there's no edge on that because the whole market knows about it. They always follow the same signal. So as a retail trader, we need to be able to create an edge. And that's what we're going to show you in today's session. So as a result, these are some of the statistics that everybody's aware. Between 70 and 90% of traders eventually lose money in the market, right? So how can retail traders close this gap, right? And the answer is very simple. We now have technology. We now have data that is accessible to everyone like never before. So we need to look at a different approach, and we need to look at quant models and data tools. And today we're going to show you what we built at MenthorQ as well for that. So let's talk about quant models, what they are, why they are important, and why they will help you trade like an institution. A quant model is not really a black box. It's a structured way of turning data into decisions. Think of it as like kind of like a GPS where the quant model can tell you where we are, where the traffic is, and what is the most probable route that we should be choosing based on the condition that we face right now. So instead of relying on emotions, our quant models can help us use data inputs, like, for example, option flow, volatility, or macro signals. We're going to talk about options today. They can help us apply rules or a statistical filter on top of this data, and they can give us an output of a clear condition. So are we in a risk on or risk off scenario? And if so, should I be buying or selling an asset? Like should I be buying stocks? Should I be selling stocks, right? And basically by looking at this data, you will be able to make better risk decisions, remove your emotional bias, and rely on data-driven insights, right? So they would give you better odds and help you manage the risk as well. An example of a quant model is the MenthorQ score that allows you to look at an asset using 4 different factors, determine whether we are in a bullish or bearish regime, and we're going to follow and we're going to show you some example about that as well. So these are really tools that help you simplify your process. They don't aim to complicate it. They really help you to simplify it, right? So as a retail trader, changing the process and changing the way you look at the data is very, very important. And that's what we're going to show you today. This is what we built, and this is why for us, quant model is at the core of our technology. So we showed you obviously how the institutional trading, we showed you the importance of quant model. And of course, if you are a MenthorQ user, you can access those quant model in the platform, and we're going to go into the details later. But what if retail traders could actually have access to the same type of data, but built in an actionable format that doesn't require any coding, doesn't require math, or doesn't require you to have access to, for example, a Bloomberg terminal, which is, of course, very, very expensive. And that's why we built MenthorQ. And basically, our approach really relies on 3 pillars. We take a lot of information, we take a lot of data, we simplify complex data using a data-driven approach, and then we create the quant models that we're going to show you today. The idea behind it is that we can look at option positioning to understand where the big money is going, where investors are hedged. We can look at gamma levels to understand what are the key reaction areas on the charts. We can look at volatility to understand if we are in a risk on or risk off scenarios. And then we can also use directional models that are built from option positioning to understand if we should be bullish or bearish an asset and more. And of course, we also have swing models and more of those that we show you later today. We're also coming into the new earnings season. So as a retail investor, there's going to be a lot of opportunities. But again, if you go into the earnings season blind, you're going to face a lot of risks. So today we're going to show you some examples also on how to use our data in preparation for earnings. The way we help traders is through, again, 3 different steps. The first is the models that we talked about. The second is our trading dashboard, and we're going to go into a demo very shortly. And the third one is integrations. So retail traders use different trading platforms. We are now integrated with 10 plus trading applications so that you can actually take in the same data that you see within our models direct into your trading application, so you can actually be actionable very, very fast. So that's very the three steps that we follow within our process. But before we go into the dashboard, let's go into why options are so important, and how institutions are using options, and why, as a retail trader, you should be also looking at the option market. So for us, and the trend that you see here, options are really the X-ray of the financial market, right? So most retail traders, they look at option and they think it's a side hustle, maybe it's really something to use for fun, to generate some income on the side, but they don't look at options like institutions do. But for professionals, for hedge funds, options really are like an X-ray machine. Options tells us where the big players are positioned. They tell us where market makers are forced to be hedged, and they tell us how the market is pricing in fear, aggression, or complacency. So options can really be a very, very important sentiment or barometer for what's going on in the market. So for example, when a stock sits on a major gamma wall, market makers may be forced to buy or sell into the moves, right? And they can create predictable zones of support and resistance. Again, this is forward-looking information. It's not looking at past price action. It's actually looking at forward-looking data. If we're looking at a skew, for example, and we see a sudden rise in the put skew, that can be a fear signal. So someone is looking to pay more for protecting for a downside move. So that can tell us a lot on what's going on in the institutional world. And also very, very important, we need to look at option expirations, because they can trigger volatility as all these positions unwind. So we are going to come close to our OPEX, option expiration, weekly expiration, daily expiration. Very, very important to take a look at this information, and we're going to show you also how you can see that within the platform. So at MenthorQ, we make this data accessible to everyone. We map gamma exposure, intraday and end of day. We show you how the skew shifts and how the volatility surface change. And we also deliver models that can help you interpret the data into actionable zones, right? So if you're ignoring like option data, it's kind of like trading blind, because you're missing a lot of the information that are key to understand why the price moves so fast during the day. So today we're going to show you also how you can use those data points, even if you are not trading options at all. Now let's go into how hedge funds or institutions are using options. So hedge funds, they don't chase prices, they manage risk, and they think in terms of exposure, regime, and positioning. So they are constantly asked the following question: are we in a calm market, or are we in a volatile environment? Are we in a risk-on or risk-off environment? And where are the other players' positions, right? So for them, options play a big role, because they can hedge against losses using options. They can bet on volatility, and they can read the crowd and the flow by looking at the option market. So this approach is systematic, is not emotional, and they allocate based on probabilities and risk rewards. Again, they're not looking at charts, they're not looking at chart pattern, they're looking at risk management, positioning, and flow. So can the retail traders think in the same way? Can you build an edge with the limited tools that retail traders have, and with the right models and structure? Absolutely. And today we're going to show you some of these tools as well. So the answer is retail traders can now access the same institutional models that are available through platforms like Bloomberg, and we want to show you what we've built and what we offer for you guys. So We provide Quant Models, gamma levels. We are integrated into 10 plus applications, and basically you can access everything through our web application, our dashboard, and we're going to show you that in a moment as well. We cover 1,400 plus assets, ranging from the most traded stocks, ETFs, indices. We also cover futures. We are one of the few companies that actually provides gamma levels on futures for retail traders. So that's very important. We also cover Forex, and we recently released our crypto gamma models as well. So if you are trading crypto, you can now access derivatives data on crypto that can also move the spot price that you see on every day, and we're going to show you some examples. Who can use this type of tools? So this tool is designed for day traders. Day traders can use our gamma levels and our futures level directly to trade the asset. Scalpers are using our system. They can also build systematic strategies on the back of our tools. Swing traders can use our models. We're going to show you some example today on earnings, but you can also use our tool if you are a position trader. So let's say that you have position open on stocks and ETFs. You want to understand if the market is in a sell-off mode or in a risk-on mode. So you can also use the tools if you are actually more like an active investor or long-term investor as well. All right. Before we go into the dashboard, we need to understand why we always talk about gamma. Why are we talking about option Greeks? Why are we talking about gamma? And basically, why is that important for any trader? So when we look at option positions, we're going to talk about Greeks. We're going to talk about gamma, delta, theta, and others. So the answer is that you don't need to really be an option expert to be able to use this tool. But you need to understand why gamma is so important, right? Because gamma is really the hidden force behind price movement. So for those who don't know what gamma is a second derivative of delta. Gamma measures how fast delta changes throughout the day. And basically, delta measures how much of an option moves based on the underlying price. Gamma, on the other hand, measures how fast delta moves as the price of the underlying changes. So in simplicity, when we are in a higher gamma regime, there is more sensitivity and market makers need to hedge faster. So we're going to see a lot of price swings, right? So understanding gamma, very, very important. Here, again, why is this key? Because behind every option positioning, there's going to be some hedging going on coming from the market makers. So we need to understand that option flows create futures flows. So most of the hedges is done through buying or selling futures, but also buying or selling the underlying. So this slide shows you really quickly what does it mean if we are buying a call and what's on the other side. So if we are buying a call, on the other side, we're going to have a market maker that is going to be on the opposite side of the trade. They're going to be short the call, and in order to hedge, they will need to buy the underlying based on the delta of the option. So the higher the delta, the more hedging activity we're going to see. And again, when delta changes fast, especially during zero ETs calls or zero ETs put options, we're going to see a lot of movement throughout the day. So take a screenshot, take a look at this slide, because this is very, very important. Why is this important even if you don't trade options? Because you need to understand that behind each move, we are going to see the hedging activity of the market makers that are actually buying or selling the underlying based on how much option positioning we have in the market. This brings us to the power of this chart, right? This is one of the main charts that we see. We're going to go and show you in the dashboard. This is our net JAX chart, and net JAX stands for net gamma exposure chart. So this chart shows you green bars and red bars. Green bars is positive gamma. that means that there is more stability in the market. Red bars are negative gamma. So those could be potential volatility zones. We use this daily to map out likely support and resistance levels that are not visible on the price chart. And we're going to show you some examples. So for example, let's say that we are in a negative net jacks, right? Let's say that we have a really strong negative net jacks. That becomes a hot zone. So that becomes an area where price could reach that area. And then again, we could reverse on that area, but we could also break through. So if we break through that area, we're going to see a very, very strong volatility. In this chart, we can also map, and this is highlighted with the arrows, we can map our put support level, which is at the bottom left, the widest red bar. We can map our core resistance or call wall at the top right, which is the largest green bar. And then we can map our gamma flip level, which is the high vol level, which you see in the white circle here, which is the level where we are flipping from positive to negative gamma. And that brings us to the next slide. And why is this so important, right? Because we need to understand also as retail traders that if we are in a positive gamma environment, we can expect a certain outcome. If we are in a negative gamma environment, we can also expect a different outcome. So when we are in positive gamma, what does positive gamma means? It means that the market overall is long gamma. It means that they're buying more option than selling. When the market buys more option than selling, on the other hand, the market makers are hedging in a different way from a negative gamma environment. So the market makers are going long when the price goes down and are going short when the price goes up. As a result, this tends to stabilize the market. We're going to see low volatility during like a positive gamma environment, and that's good for the market, let's say. When we are in a negative gamma environment, on the other hand, the market is short gamma. So they are like basically selling more option than buying. So when they do that, the market makers are also basically hedging differently. They're going short when the price goes down, and they're going long when the price goes up. So as you can imagine, this way of hedging is actually going to bring volatility up. So we're going to see a larger volatility, a higher volatility. That doesn't mean that if we're in negative gamma, the price is just going to drop. It means that we're going to see sudden shift in the market to the upside or to the downside. So why is this important? Because if you're trading, for example, NQ futures, and we are in a negative gamma environment, and you typically have a 20-point stop loss, if we are in a negative gamma environment, most likely you're going to be chopped out very fast because of the way the market structure is formed. So because we are in a very volatile environment, again, you might want to readjust your position sizing. You might want to readjust your stop loss, your take profit targets, and just by knowing this can really help you. All right. So before we go into some of the example, I want to pause there. Please send us any comments, any questions, and we're going to answer those. We also want to share this for you guys. We started a series of events that are available for all members. So we are actually live about 6-7 hours a day, every day, and some of these sessions can be accessed for free. So if you just create an account, you can actually access all these sessions. We are starting with the European market kickoff at 3 a.m. Eastern. So for European customers, you can access this, I think it's 9 a.m. European time. We're also live at 8 a.m. to 9 a.m. In the New York market, pre-market opening with Patrick. And then we're going to have some live trading sessions. Those are for our pro members. But then we're also back live again at 2 p.m. and 3 p.m., from 2 p.m. to 3 p.m. for a post-market deep dive. So anyone who creates a free account can actually access those 3 sessions. And we're also going to have weekly live events that are going to be available on our YouTube channel. So just follow us on YouTube and you'll be able to access those. For those who want to join us, we actually have now 25 coupons available. So if you want to join us, our premium or pro member, you can actually go to our pricing page and use the coupon code LIVE25, and you get like a nice discount. We only have 25 available if you guys want to join. So let me know if you have questions. All right, so we're going to go into some trading examples, and we're going to go into the dashboard as well. So first, let's look at some past example from last week, right? So why are these levels going to be important for you guys, and why can you use them? So here we see an example on QQQ from July 17th. The market opens higher, gets rejected on JAX3, drops all the way down to our core resistance 0 DTEs. So those are 0 DTEs options that are expiring on the same day, very, very important. And then basically that acts as our support level. So this can be a very good example on how this core resistance and JAX level can be used as support. Same example on SPX. This is from July 16th, last week. The price gets rejected around the HVL 0 DTEs, goes all the way down, almost to the HVL and 1-day minimum to the downside, and then bounce back up. So again, important areas. If you're planning a trade, you have a lot of support to the downside for a potential reversal, and this was SPX on July 16th. The levels also work on other assets. So we're going to look at crude oil. So this is an example on crude oil future, July 17th, last week. Market opens higher, comes down to put support and put support 0 DTEs, and then reverses all the way up to almost the 1-day max with a lot of breakout points throughout the JAX level. So very, very important. NQ, July 17th, same thing. We open higher, core resistance really acts as a resistance. In this case, the market drops all the way down to our JAX3 and JAX5, retest the core resistance, and actually we see a strong break of the put support. So again, this is like we mentioned, like if we break through these support levels, then there's a lot of liquidity that gets injected there because of the way the market makers are hedging. And we see these strong 2 candles all the way down to JAX3. We retest that level, we come back, and then we retest our core resistance 0 DTE again, and then we drop, and that's like a very good example. Bitcoin. So we now have levels on Bitcoin as well by looking at the derivatives market. This was from last week, July 18th. We dropped to our HVL 0 DTE level, and then all the way up to the 1-day max level, and then that act as a ceiling for that day, and then we rebounce back to the core resistance. So very, very important. Also on Forex, we have a really strong blind spots level. This is an example on CAD USD, July 21st. Again, blind spot 10 was really strong support all the way to blind spot 4. So the market removed in one direction. Those could have been really interesting levels to place on your chart as well. All right. Next, we're going to go into earnings, and then we're going to go into the dashboard. I'm going to give you a demo of the dashboard, right? So let's look at an example of last week. So this is JP Morgan. So JP Morgan, the estimate, so beat the earnings, but there's still kind of like some concern about the outcome for the future. This was on July 15. So let's look at the dashboard, and then we're going to go into details. There's going to be some interesting earnings coming tomorrow, so we're going to look at the data as well. So here what we have is our Q score. Our Q score is telling us that, so first we are in a positive gamma environment. You see that on the left-hand side. Our option and momentum score is very high. So this is what our Quant Models is telling you. We are in a bullish option cycle and we are in a bullish momentum. But again, pay attention because we see an increase in volatility. Of course, we are coming into earnings, so the volatility around earnings is much higher. We're also in a very, very positive seasonality, right? So this is what kind of like the model is telling us. So very strong option positioning, very strong momentum, strong seasonality, but again, pay attention to volatility. The option matrix is telling us that on July 18th, 36% of gamma was expiring. So again, we are at July 15, that's the day of the earnings. July 18th, we see about 36% of gamma expiring, but we are overall in a positive gamma environment, which is obviously good for the volatility of the asset. If we look at the skew is telling us kind of like the sentiment in the market. So the skew is looking at out of the money puts versus out of the money calls. If we are in a call bias environment, that means the investors are willing to pay a higher volatility for the premium on the calls versus the put at the same moneyness. So again, this can be used as a sentiment indicator for your trading. So here we were also in a call bias environment. And then next, we can look at our swing model. So the swing model is telling us our lower and upper level for the next 5 days. So this was the data that you would have got on July 15th, the day of the earnings. We have our lower band at 278.83, and we have a risk trigger at 298.57. The model success rate over the past 118 days was 82%. So again, that means that in simplicity, in 82% of the days, the price of the asset, so in this case, JP Morgan, 5 days in the future closed above the lower band, closed above the lower band. So in this case, we're looking to stay above 278.83. So how can you then use this information? Well, you can use in different ways. And here we can see basically how you can then plan your swing trading and your kind of trade using the level. So here we have our lower band, we have a risk trigger at the top, and again, this is the range that you are looking for the next 5 days. If we look at the price from today, let's see where JP Morgan is at. We are at 293.56, so we are kind of like going towards the risk trigger level that we see on the chart. All right, next one. Netflix, right? So Netflix is, again, they beat earnings. The growth was 16% in the second quarter, but there was some concern during the earnings, and this was from July 17th, right? So again, let's look at what the data is telling us. This is the Quant model. So we see, again, here, we are in a positive gamma environment, but we see that the option market is actually in a neutral position, right? So we're still in a bullish regime, but the option score is not 4 or 5, it's 3. So the option market is maybe concerned about the fact that Netflix is at all-time high, concerned about the future growth, and they are reacting in the same way. Momentum is neutral, so we don't see a bullish momentum on Netflix currently. We don't have seasonality, and also the volatility is kind of neutral as well, right? So this is what the models are telling us. But let's look at the matrix. So this is what the matrix that you see on the day of the earnings. And what is very interesting is that for the expiration of July 18th, which was the weekly expiration from last week, at the beginning of the day, we saw an increase in negative gamma by about 2 million and you see this from the column JEX change. So that means to me that maybe a lot of participants are basically worried about the earnings, and maybe they're scared that Netflix is not going to do so well. So they are like acting, and they're using the option market to do that. If we look at the skew, we're still in a call bias environment, but you can see how the skew kind of is going towards the neutral line. So we're going towards the orange line there, but we are still in a call bias environment, right? And then finally, we want to look at the swing model. So again, we are still in a bullish bias coming from the swing model. Our lower levels to monitor is 1,184 for the next 5 days, and our upper level is 1,315. Again, look at the backtesting at the top. The models is telling you that the success rate over the past 118 days is about 86%. So now, if we look at the levels, what we see is that Netflix, the day after the earnings, obviously opened much lower. You see that in the chart. We have a lower band there, and then we have a risk trigger. So if we look at the price, now let me open a Netflix chart. The price now is 1,203. So Netflix is kind of approaching our lower band, right? So again, we are a few 20, 30 points or $20, $30 from that lower band. So that lower band can be your support area, can be your stop loss area, can be used in many, many different ways. But this is important because we are using data to potentially look at what the market is pricing in. All right. Next, we're going to go into the dashboard. Please, there's a lot of questions, so thank you, Andres. We're going to reply to those in a very, very short second. But let me go into the dashboard first. All right, so within the dashboard, and then we're going to go over some of the new stuff that we've developed. So once you have access to the dashboard, on the left-hand side, you will have different menus. You can have our indices and stocks. We have both end of day and intraday for indices and stocks, about 1,300 plus assets that you can access here. We also have our futures section. So for those who are trading futures, we now released our active futures there. So let's imagine that you're trading indices. What you want to see is what contracts should you be looking for. So whenever we are trading any assets, think about where is the gamma coming from? Where are the contracts with the highest option activity? So if you are trading crude oil, you probably want to use CLU, which is the contract which has the largest volume and open interest. If you're trading gold, you probably want to use GCV. Here, we still see kind of like higher volume and higher ROI. And if you're trading any of the other assets, here highlighted in yellow is going to be the contract which has the largest option activity. Why is that important? Because largest option activity means larger reaction. So whenever you're trading any of these assets, always look for the contract with the largest option activity, and then of course you can monitor what's going on also on the other contracts as well. Then we have our crypto section right here. So for those who are looking at crypto, we now have our Quant Models, our option data on crypto as well. So if you are following Bitcoin, Ethereum, you can also access this. If you missed this, just go back on our YouTube channel. We also have our product release section there. We were live last week or the week before, and we presented the crypto stuff as well. We have our screeners. A very, very interesting one is our Q-score screener. We're not going to go into the details of the Q-score screener today, but there is a lot of value there as well. Integrations, and then of course, here you can access all the resources, all our video lessons, all our documents. So if you're interested in products, and you're interested in, for example, our swing trading models or our gamma levels, simply come here and take a look here. We have a lot of documentation there. But let's go back to the dashboard and let's look at some example, right? So tomorrow we have Tesla, Google reporting. So let's actually do a nice use case and just look at the data. So please, guys, if there's any tickers that you want me to cover, please paste it in the comment. I will start with Tesla, and then we can look at Google. But if we open Tesla, let's look at what the quant models and what the data is telling us, right? So first of all, I always look at this section right here. We are in a positive gamma environment. Again, very, very important. Positive gamma means there's going to be lower volatility because of the way market makers are hedging. Negative gamma, higher volatility, and of course, that can help you manage the risk accordingly. So we're still in a positive gamma environment. In terms of option activity, we are again neutral. So again, the market may be concerned of the earnings. They might be repositioning. You can also go back in time and see how things have changed over time. We're now in a slightly negative seasonality. We are very low on volatility, which is it's good, especially if you are positioned for an upside move, because that means that the market is still not scared about potential outcomes. So the volatility is still low and the momentum is still very high, right? So this is what the Q-score is telling me right here. But let's actually go down and let's see. So the first thing we want to do is we want to look at our positioning. So there's a very strong call activity, call positioning at this level here. 350. This is our core resistance. And then, of course, our put support is at 250, and our high vol level is at 320. The high vol level is really this level here that you see in yellow. This is going to dictate when we move from a positive gamma environment to a negative gamma environment. And you can see how much put positioning, put gamma we see on the downside. Next, we want to look at also not only looking at the full option chain, we also want to look at the next expiration. So here you see what we call 0DT's expiration, but in the case of stocks is the next weekly expiration. So again, the expiration of July 25th. We can see the levels for July 25th. So we still have our 350 level, and we also have our put support just for this expiration at 300, and our high vol level is 320. And then, of course, we can also monitor the next expiration. Why is the July 25th expiration very important? Because we have 27% of gamma exposure expiring on that day. So again, very, very important, because every week or every day, whenever there is an expiration, market makers are releasing their hedges. That means that whenever options expire, they do not have to hedge any longer. So the fact that we see 26% or 27% expiration on that day is going to be very, very important. We can also monitor this by looking at the matrix. So here we can see the same data. So the next expiration is 27%, and then we have a bigger expiration in August with 12.6%, and then of course our quarterly September. And then you can see here also how JAX changes throughout the time. So for example, from yesterday close versus the previous day, we added 14.16 million of positive gamma to this expiration here, right? Next is we can scroll down and we can look at our skew. Again, the skew also tells us we are in a call bias environment for Tesla. So investors are willing to pay higher for implied volatilities on calls, out of the money calls versus puts. So again, this kind of like is also a nice sentiment indicator. And then of course we have our swing model here. So the levels that obviously we should be looking for is 303.18 to the upside, 353.8. These levels are also in conjunction with our put support and core resistance. So very, very important to monitor those. And then we can go into the chart. So if we go into the chart, we can then have those levels directly into your chart. So we're now at 330. We have our put support for the next expiration at 300, and then we also have our put support for all expiration at 250 right there. But definitely this level is with the one you want to monitor. And then of course the upside, we have these 350 levels right here. Okay. Let me see if there's any questions, right? So all right. If we look at also gamma levels, and we have some really nice example for today. So if you are trading and you want to understand what are the areas where the market could stall, come back, or reverse, then using gamma levels can really provide you an additional support, right? So again, if we look at NQ today, we open kind of like in a sideways market, and then we had a very important drop in the morning, right? So we have a very big drop. Again, drop was the HVL, 0DTs, and HVL. So this, again, we are going into kind of like a negative gamma environment here, and basically these moves are accentuated at this level. And then we also break through our put support, but then we also have our supporting levels at the bottom. So we have our JAX 1-day minimum, and then we are basically less than 10 points away from those price reverse, and now we're still kind of like in a downside move. But again, those are really interesting areas that you can kind of use to monitor what's going on. We can do the same thing on stocks. So if we look at NVIDIA, again, we open lower, but let's see what the level is telling us. Again, this JAX level really acted as a strong support for NVIDIA this morning, and then we kind of like reversed. Now, of course, we are in a kind of like a sideways market to see what's going on, right? So again, using those levels here can give you really supporting areas where the price could stall, reverse, be rejected, or there could be an acceleration to the downside or to the upside. So whenever we break one of these levels, important to understand that also that could be an inflection point. So always treat these levels similar to what you would treat a support and resistance area coming from the past price action. Treat these levels as areas where there's going to be an increased hedging activity, and that could result in a strong acceleration or a reversal. All right, so now let's go back to the slide. And before we go into the presentation, I just want to put this slide again. The best way to learn how to use some of this data in real market scenarios is to also join our weekly events. So again, on the left-hand side, you see the schedule. This is available for everyone. So just create a free account, mentorq.com/free, and you'll be able to access our calendar. In the dashboard is going to be available to you, and also some of these sessions are also available on our YouTube channel as well. For those who want to join our premium or pro membership, use Live25. It's available for today, and it's going to give you a 25% discount. We only have 25 coupons available for that code, so just use it, and you can go to our checkout page and basically access the data there. So let's go into some of the frequently asked questions, right? So when do the levels update, right? So this is a very common question that we get, and we also have a lot of documentation on the website, but let's go into the details. So stocks, ETFs, indices, end of day levels typically update by 6 p.m. Eastern. Sometimes it's much faster, but just as a guideline, use 6 p.m. Eastern as a guideline for you to understand when the new data is available. If we look at intraday, we have 14 snapshots per day. Every 30 minutes, we have a new snapshot, so there's new data available for you. And then we are going to go back into and show you some good example on how you can use the intraday data as well. Futures, 11 p.m. Eastern, so they update once a day at 11 p.m. Crypto, 8 p.m. Eastern, so those are also updated once a day. We're also going to go into intraday for crypto, but that's going to take a little bit of time, but we will have that. And then blind spots level, 11 p.m. Eastern, right? So hope that makes that answer some of the questions. The other questions is, you provide levels on ETFs and indices. If I trade futures, why should I convert levels and how it works? All right. So very good question. We get that a lot, but it's very important that we go into why this is key, right? So let's look at this slide. So what you see in this slide is really the net gamma exposure chart for 3 different assets that move in the same direction. We have SPX, the index, SPY, and ES, right? And basically, why are we showing this? Because with MentorQ, you can access data on all 3 of these assets. Those 3 have different option chains, so they have different chains. So the option chain that you have on SPX is completely different from SPY, and it's completely different from ES. Why is that important? Because it can provide you a great insight on what's going on. So the answer is, first of all, let's analyze who is the customer and who is the type of customers that would trade these assets, right? So if we look at SPX options are mostly traded by institutions. There's tax reasons, the sizes, and their settlement reason for it. If we look at SPI options, they're actually a very good instrument for asset managers, retailers, because they offer a lot of liquidity and flexibility, but also think that SPY is also an asset that goes into your 401k. So if you want to get an exposure on the market, you're going to probably buy a SPY ETF, and you're going to hold that for a very long time. So the customer that is actually buying or selling this option is way different from who's buying and selling SPX. And then, of course, you have the future. So who actually is trading futures? So we have CTAs that are trading futures. We have retail investors. We have institutions, right? So looking at those three in conjunction is very, very important. And this is kind of like a breakdown. And basically, how can we compare basically those levels across all three and use like this at our advantage, right? So for example, if all three of these assets show a put support at the same level, that's a high conviction area, right? That means that not only we are near a very important gamma levels on SPX, but we are also close to very important gamma levels on ES and SPY. So that's going to be a very strong, a much stronger reaction area than just simply looking at one asset, right? Or, for example, if SPX and SPY are in a positive gamma environment, but ES is showing a negative gamma, we are now into a flow conflict, right? So we are in a zone that like, hey, two assets are telling me one story, one asset that moves in the same direction is telling me another story. So how can I use this to my advantage, right? And basically, this is why we have all three of those, because you can then convert those into standardized levels, so you can actually trade futures using the full map of dealer positioning in your chart. And again, this is additional data that you can use at your advantage. So let's go back into the indicator now, and let's show you how we can now convert these levels, right? So what can we do within the indicator? So let's go here. So first of all, here I have NVIDIA. Let's go back into my end of day indicator. And let's say that I want to convert SPX to yes, and I want to convert SPY to yes as well. Right. The way you convert the levels, and we're not going to go into details today, but we do have the ability for you to use an automatic ratio or a manual ratio, right? We have videos documentation that shows you how to do that, but for simplicity, let's just use our auto ratio, and then let's go into our yes chart, right? So now we're going to see a lot of levels here, right? So now we have a lot of information there. But why is this important? Because we can now map out important areas coming from SPY. We can map out important areas coming from SPX. And we can map out here important conviction areas coming from both assets, right? So now you have not only the ES levels, but you also have some important areas that basically can tell you where the SPX level are. So now we have, again, we have our HVL 0ETs level on ES. We have our HVL level on ES, but we also have some very important key areas on SPY. And to the downside, we have our put support here on ES, but we also have areas here that are very important on SPY, right? SPY and SPX. And if we want to bring the levels back, we can bring them here. We can see that, again, if the price was to move to the downside to these areas, we have a very important area coming from SPX and SPY, which is our HVL area. If we're going to the upside, we're going to face up a wall coming from SPX and SPY. So we have our core resistance 0ETs and our core resistance 0ETs and HVL, and gamma wall here on SPY as well. So again, having those there can really help you add an additional layer to the picture, right? We can do the same thing on NQ. So if we want, we can add QQQ levels to NQ. And we can add NDX levels to NQ. Okay, very, very simple. It's done with the indicator. Now we can go on our NQ chart, and we can do exactly the same thing. So we can see And again, there's a lot of data here, but don't be scared about having too much data. What you want to map out is really those important high conviction area that you see here. So again, take a look at where the price stopped in the morning. We stopped at the HVL of QQQ and the HVL 0T of NDX, right? Very, very important. To the upside, we have a very strong area right here. And then if we go further up, we also have our 0Ts levels right there, right? So take out the levels now. And now we can easily trade with a roadmap that is telling me that this area is important, not only because we have our put support coming from NQ, but we also have an important area of conviction coming from both NDX and QQQ. To the downside, this area is going to be very key. We saw it, the price bounced exactly at the QQQ level right there. And if we go to the upside, we need to break through this area first, which is also a high conviction area coming from QQQ and NDX. And then, of course, we have this area all the way at the top, right? So again, in less than 30 seconds, I basically built an idea of where my trading activity can be for the day by looking at the levels. All right. Thank you for the question, guys. We're going to answer that in a second. Let me just go back to the slide. All right. One of the questions that we always get is, when should I use end of day versus intraday, and what is better, right? So the answer is, and let's go back to the chart. You have the full flexibility of using both the intraday and the end of day. But let me show you the power of the intraday data. So I want to show you a use case, and we're going to go into the platform, and we're going to go into intraday, and we're going to look at SPX. But let's go back to last week. We're going to go back to the 16th, I believe it was. All right, and let's open up the SPX chart, and let's look at the data from the 16th. So I prepare it here in the chart. This is the 16th that you see here, right here. So let's look at how you can use now the intraday data to your advantage. So here we see that we are opening higher, but we are kind of like stalling throughout the day, and then we have a sudden drop right here at about 11:15, and then we have a recover around 1 p.m. right here. So let's go into our intraday dashboard. So you can access the data under intraday. You can type the ticker. You can also go back in time if you want to replay the data. Here we are at July 16. And then what we see here is we have different charts. So first of all, we have our net gamma exposure chart, all expirations. So we are looking at the full option chain of SPX, but we also have our 0DTs net jacks chart for SPX. So in this case, we're only looking at options expiring on the same day. You can also access all the different snapshots. So we have 14 runs for every day, and we start at 8 a.m. in the pre-market, and then we start again at 9:50, and then all the way through 3:30. So first, you can kind of replay by scrolling back with your arrow all the way throughout the day. So you can actually see how the net jacks 0Ts, all expiration is going throughout the day. So if we go back to the open, we can kind of see how this changes right here. But what's interesting is not only looking at the net jacks, but actually looking at the changes versus the end of the day, or the changes versus the previous snapshot. So if I go back in time, let me go back all the way to the beginning. All right, so now we have our 9:35 snapshot. So you see it here. We are 9:35. We are comparing this with the 7:45. So this is like the pre-market snapshot with the updated open interest. So we see a lot of like negative gamma piling up at this area right here, right? So let's scroll back and let's go to our 10 a.m. We see an increase in negative gamma right here. And then what we see here at 10:30, we see some kind of positive gamma piling up, but then suddenly around 11, we see a lot of negative gamma. So if we go back in the chart, kind of like the price has stalled throughout the day, and then we see a sudden spike in move right here. So let's go back and let's go forward. 11:30, just negative gamma piling up, and that's when we see this really strong move to the downside right here, right? And then let's move forward. Still a lot of negative gamma 12, but then suddenly we start seeing a shift from 12:30 to 1 p.m. So then when we look at 1 p.m., we are right here. This is when we start seeing an increase in kind of the upside. And again, let's see that we look at the data at 1 p.m. We still had about 20-25 points till the close to the upside, right? And then you can kind of monitor this as it evolves from the snapshot. So again, we closed in a very strong positive gamma here. But again, the other option would be to look at the difference between the previous snapshot. So what you want to see is how the previous data has changed compared to the snapshot before. So again, we go back to our 11. So 10:30 actually compare from 10:30 compared to 10, we actually had a lot of positive gamma increase. If we go to then 11, we now have some negative gamma, more negative gamma, and then kind of like we start seeing a shift. And again, you can use that to confirm the direction by using the intraday snapshot. You also have access to the intraday indicator. So I could actually open this up right here. It requires that you update to the latest version. If you're using TradingView, there is no API on TradingView, so you do need to update the indicator. You also, if you wanted to update to the latest snapshot, you have to also update it as well. But here what we're seeing is our 12:30 intraday levels. And then if I wanted, I can actually easily convert this to my future. So if you're trading ES, you can now have intraday gamma levels coming from SPX directly on your ES chart. So again, now we have our end of the level. We saw our conviction areas right here. We have our end of the levels there, and then now you also have our intraday level. So again, very important. The market stops at the intraday put support level that was available on SPX right here. So you also have JAX2 from ES, put support from SPX. So now you have additional kind of tools in your arsenal to understand where the market is going. So I hope this helps. And now we're going to go and take some questions. Let's see. All right. So let's go first. What do you mean by quant? Quant stands for quantitative models. So it's really taking a lot of information and simplifying it for you guys to use it. So taking the same approach the large institution use. So when you look at the quant desk, they typically work with data. So they typically don't look at charts, they just look at data. So Quant Models really is the same approach. Question from Andres. Regarding positive and or negative environment, usually the negative environment happens when puts are stronger than calls, but normally when calls are stronger than puts. So to understand if we are in a positive or negative gamma environment, simply look at our net gamma exposure chart and just on any asset, and you will be able to immediately see that we are in, well, first of all, we are in a positive gamma environment here. Second of all, there's not a lot of negative gamma on the put side here. So we are in a very, very strong positive gamma environment, you can also look at the matrix. So again, what the matrix is showing you is the overall gamma exposure. So if you see green, we are in a positive gamma, and then you can kind of see the overall exposure on different expiration. So even though we might be in positive gamma, you also want to see if we are in positive gamma across the next future, or if we are just positive because maybe the further expiration are positive, but the closer one are negative. So this tells you exactly where we are positioned at different expiration in the future. So why isn't the NQ dashboard as complete as the NDX? There are some data limitation that we have for futures. So not all the models are available for futures. Also, you need to account that futures have rolling. So the history might be limited. So for example, crude oil only has monthly contracts. So they don't typically stay there for a very long time. So there is a lot of issues in terms of some of the historical data that we have. So that's the main reason, basically, because futures have an expiration, they roll to the next expiration. So it's also challenging to build an historical data model that can replicate that. So that's why we have that. Hope that answers the question. So question from Andres, when you compare this picture of intraday July 16, yes, of course, the intraday is available every day. So as soon as the market opens, as soon as we have the new snapshot, you'll be able to access them right here. So today we're looking at 7/22. So then yes, you do have the intraday data there. So yeah, it's available every day on stocks, ETFs, and indices. Let me know, guys, if you have any other questions. We have one last question that we get a lot. How do I get up to speed, and what videos should I start with? Right. Okay. So in order to get up to speed, if you are new to this space, first of all, take a look at the left side. First, we have our live events. Again, if you create a free account, you can access this. This is our calendar. We also have our YouTube live events right here. So follow our YouTube channel, and we're going to be live every day almost. If you then want to learn more, let's start with the academy. Sorry, let's start with the guides. So click on any of these sections right here. You have about 300 documents here in written format that you can access. So if you just want to learn more about options, we have our knowledge base. So you can actually come and learn more about delta hedging, about volatility, about pricing. If you want to learn about trading strategies, then we have our all our trading strategies here. So we have our bearish, bullish, neutral trading strategies. If you want to learn about our products, then you can come here and learn about our, for example, intraday gamma models, our Q score, everything is right here. And then if you want to look at back testing, then just simply come to our quant strategies. You can use our swing levels back testing, our Q score back testing. So here you can look, for example, on different strategies on how you can use the Q score to build a model. Here we have all the rules, the performance, all of that stuff. We also have some backtesting results on our crypto quant models, and we also have some backtesting results on the gamma levels. So if you want to access all of that, are available here. And then next is really the academy. So come to the academy here. We have a lot of courses available for you guys. Some of them are also accessible for free. You can see the tag here. So all the free ones will be available for free. The ones that I would suggest to start with is really our gamma levels course right here. I'm also going to put it in the comments. And basically, that's going to really get you up to speed very, very quickly on why we do what we do and why this is important for everyone. Okay, we have another question. Does intraday data or end of the data available for future markets? So for futures, we have end of the data, but you can actually use the intraday levels coming from the other assets, so NDX or QQQ, to potentially convert to futures. So if I want to convert NDX levels to NQ, you can do it here, or QQQ levels to NQ. Again, very, very simple. And then there's another question from Emerson. A suggestion for those who operate NQ, could you make the converted NDX level available on the dashboard? Well, there's not really a need for it because all the indicators have conversion. So basically, you're just adding a manual step. So it's already done by the indicator. So I don't think there's a need for it. You know, like there's no reason why you would want to manually have those, because they're already done by the indicator. So here I can see, for example, if I just wanted to plot my QQQ levels, I can simply click on the box there, and now I just have my QQQ levels without the futures levels. So there's no really need to do that. There was also questions on integrations. So let me go back here. Another interesting question, do we need to buy real-time data for converting from another assets to futures? No, you don't need to. If you don't have a data feed, you can always use the manual ratio, but also if you don't have real-time, you can always use the auto ratio. So within TradingView, you don't need a data feed, and you can use both the auto ratio and manual ratio. And depending on what platform you use, you might just need a data feed for pricing, but you don't need a real-time data feed. Can you rephrase the question, Andres? What do you mean by UOA? I don't understand what that means. I use Quant Tower, yes, of course. So if you come back here, let's go through it. We have all the integration right here. So we have Quant Tower. Quant Tower can have both manual and auto ratio. So you would need at least an end-of-day feed to be able to do the automatic conversion. But if you don't have the end-of-day feed, then you can do a manual conversion. Then we have Transpider, Bookmap, Sierra Chart, Atas, NinjaTrader, and yeah, I can show you also other platforms if you guys are interested. So Emerson, the conversion is purely a mathematical formula. So if you come to our academy, to our integration section right here, just simply go to level conversion, and this will show you exactly how to do the conversion. If you see a difference, it's purely based on the price that Ninja is taking compared to TradingView. So if you want to have the same conversion, just use a manual conversion on both, and you'll have the same level. So it's purely mathematical conversion, very, very simple. Question. So I don't have Quant Tower right now, but if you want to see the demo, I'm gonna simply Just go to our academy right here, and then go under Quant Hour, and here we have a demo of it. So you can watch the video there. I don't have Quant Hour. I don't have Quant Hour in my account right now. Can you use it with Quant Hour white labels? We would have to check. Just send us a message and we can test it out. Not sure. All right. Okay, so unusual option activity. Yes. So Andres, if you come to the dashboard and go into our screeners, let me show you here. So if you go under screeners, we have multiple screeners here. So first of all, you can screen for gamma levels or gamma change. So if you want to look at the highest change in gamma or highest negative change in gamma, you can do that. You can also screen for gamma levels. So if you, for example, like the core resistance level, you can actually look at stocks that are approaching. This is using end of day data. So these are stocks that at the close of yesterday, their price was very close to core resistance. So for example, interesting to see that both SPY and QQQ were at core resistance at the close. So again, we saw strong reaction right here at the open. Very, very interesting. And then, but then we also have volatility. So what you're asking for is actually under volume. So we have unusual activity here. So we have a screener for that under volume. And then you can see the unusual activity here, and then you can kind of look at the data there. So yes, I think we have there. You can also go back in time, so you can always go back in time here, and yeah, and you can access the screener historic. So question about Quant Hour and the Thinkorswim. We're not going to cover this in this session, guys. Send us an email at info@mentorq.com, and then our support team will be able to answer any of those questions. Yeah, we don't really have time to cover them here. Amazing. Glad to hear. Great work, Andres. Great job. Yeah, let me know, guys, if you have other questions. Again, I'm going to put this up the last time. Tomorrow, today, we have a lot of different sessions with Patrick. So Patrick is a trader with about 20 years experience, and is dedicating 6 hours a day with us, both for our free and premium and pro members. So please take advantage of these sessions, and basically they're all available for you. I'm going to show you where you can find them. And then if you want to join us, don't miss out on this live 25 coupon. You can go to our website and apply that. But for those who are interested in the events, let me show you. Simply go to the dashboard and go under on the menu. So even if you have just a free account, you'll be able to add to our live session right here, and then click on live event calendar, and that's going to bring you to our calendar event. Just give it a second. And then what you see here is all the links to the session. So today we have post-market session. You'll be able to get access to the Zoom link there. We have the session tomorrow. You'll be able to get access to the Zoom link there. So just add this calendar to your Google Calendar, and you'll always be up to date on our latest sessions. And those are all available, so you guys can access this session here, the European market, the pre-market deep dive, post-market deep dive, and so on. Very, very important. Patrick is available. He's going to answer all the questions that you have. So please, guys, use them because they're very, very, very great. Today, we're also going to be live again. So on our YouTube channel, we are going to have a nice session, macro session on gold, on the dollar index, together with Jay and another couple of guests. So please stay tuned, join us. And for those who have any questions, please send us an email at info@mentorq.com. We are always happy to answer. Next week, we're going to do another session, and we're going to be focusing on some more of our advanced quant models, our Q-score, our screeners. So we're going to show you how to use those. But if you want us to cover anything in particular, please send us an email as well at info@mentorq.com. All right. Thank you, guys. Really appreciate the time, and see you soon, and see you this week, and see you live later.